Good morning, everybody. Thanks for joining us. Running slightly behind, so just pulling everything up here, and we'll get going in just a minute. Let some people file in. TGIF, thanks for joining us on Friday here as we head into the weekend. Whatever your plans are for the weekend. Good morning, Mr. Hedge Fund. All right, let's go ahead and jump right into it. As always, here at GameEdge, for our pre-market prep, we cover our three pillars: sentiment, structure, and trend. Obviously, this is Michael coming to you on Friday, November 7th, with our pre-market prep. As always, we start with the trend, which is our market trend model. It's based on the tick index. Quick orientation here if you haven't joined us before. The bolded white CT, or the bolded white line, is our CT, or our cumulative tick. This is our intraday instantaneous cumulative tick. This is the tick US. This includes all exchanges. This is kind of our kitchen sink. And then what we want to look for is the CT, or the bolded white line. If it's moving lower or below our shorter term moving averages or momentum moving averages, this obviously it's indicating more selling versus buying in the overall market. And then the colored ribbon, this is our longer look back period. This is how we position our capital for extended periods of time. If the red is below cyan, that's a bearish trend to the downside. If the red is above the cyan line, that's a bullish trend. Currently, we're under the ribbon and to the downside with negative slopes, so that is a bearish trend in the overall market. Obviously, and we've continued to see the market pull back. Up here is our breadth indicator: new highs versus new lows. New lows outpacing new highs yesterday by a decent margin. So again, more stocks were being sold than bought. So again, that's bearish and a little bit more negative. And then our filtered cumulative tick indicator, this is larger block orders, plus 1,000, minus 1,000. Again, these are institutions and larger market participants. Obviously, if that is below zero and trending down, then institutions and larger market players are selling more than they're buying. And we've seen multiple days across the board. We did see one bounce day, but really it was a very tepid bounce in the filtered cumulative tick. We want to see the filtered cumulative tick up in the 100,000 level for institutions really to change the trajectory of the market and start turning it back around. So we'll continue to watch this, but as of now, trend is down. As we're under the colored ribbon, we have the propensity to short the bounces until we get back above this colored ribbon. That's been our bias to the downside, and that's currently how we've been playing this move, and how we'll continue to play the move unless we recover the colored ribbon and really start to see this market trend model shift back to the upside. All right, moving on to the tick RC. Again, this is a little bit more quality tick. This is how we base our mechanical portfolios, and they've been off for a significant amount of time now. When the, again, bolded white CT is below the colored ribbon, our mechanical portfolios are off. That would include our P-Trans and PGAX, as well as our wheel strategy. We do not enter positions to the inner positions in the portfolio. And again, here was that bounce back to the upside, again, below the ribbon. Again, this is what I talked about yesterday, was this was prone to failure back to the downside. And I was, or our overall thesis was that most likely we would fail under the colored ribbon and continue to the downside, which is what happened early in the morning, roughly around 10:30. We started crossing below these shorter term momentum moving averages and provided an opportunity to get short on initial bounce and then ride the wave to the downside. So again, we'll continue to watch this. If we recover these shorter term momentum moving averages, we'll watch for a failure at the colored ribbon. If we do emerge above the colored ribbon, then we'll change our thesis a little bit, that we could have a little bit longer bounce to the upside. All right, moving on to the SPX. This is the largest, most notional options complex and structure. That's why we look at this. We separate it in the SPXA, as you'll note by our web app ticker up here. Again, these are our cruise ships and tankers within the overall market. This is what steers your kind of 40,000 foot view or your long trajectory for positioning. We are still call nominated heading to November expiry, but you do notice the erosion in the net delta column, the exposure of in the money puts above us here, and then out of the money put speculation to the downside. This was completely green net delta the past few weeks, and then we started to see some cracks in the ice. And now we're seeing a little bit more erosion of the overall structure, even though we're maintaining the call dominated structure here. So we'll continue to watch this. Key points are we're within a significant wide transition here. To the downside, 6,700 is that key gradient level that we're watching here. And then below that, we have 6,650. To the upside, 6,750, and then 6,800 are key levels we'll watch within the SPXA. Moving on the SPXP, again, all expiries turned on via our web app over here. Tiles, we are put dominated via the net delta column up and down the structure above spot price, which is the right-hand plane, and below spot price, left-hand plane. You'll notice 6,700 large area of net OI and a structure there that is completely put dominated though. So we'll watch that area for below 6,700. We would anticipate some more weakness to the downside. Again, you can look back from previous weeks and notice that net delta column was completely green. And then we started seeing some erosion as we were talking about with individual tools and the overall structure. And then we completely changed to put dominated within the overall structure. The main takeaway for the put dominated structures, we'll head into the 0DT slide here in a few minutes, is this negative gamma condition, put speculated condition, enhances the moves both directions to the upside and the downside, as you've seen, and that obviously increases volatility. In a more call-dominated positive gamma environment, the structure is dampened via dealer hedging metrics as well as market participants, so that again attenuates the moves, and that's why you get a little bit more grinding effect via the trend compared to the put-dominated structure, where you're very volatile and back and forth. Accentuated price action movements. So that's why it's much more difficult to trade in a put dominated negative gamma structure for 0DT traders. All right, moving on to the SPXP GEX ratio, or what we call a gamma edge ratio. Again, this is a put call ratio, but we add a gamma component. So it's a short dated call gamma versus short dated put gamma ratio. I spoke about this yesterday, that we were slightly above the 1, but could easily turn to the downside. And that would indicate that the short dated call gamma was leaving. The overall complex short dated put gamma was coming in, and that's put speculation to the downside. And once we're below the 1 level, that gives the benefit of the doubt to the bears, and then the opportunity for us to move to the downside even more, which is what occurred obviously yesterday. So what we'll look for now is the SPXP. If it is moving to the upside, we would need to see the overall GEX ratio moving to the upside, indicating that short dated put gamma is leaving the overall complex, at least expiring or being monetized, and then short dated call gamma is overriding that overall ratio. Again, we're reaching an extreme on the gamma edge ratio. Again, what I talked about over here, 0.5, we saw that initial bounce, but then we turned back to the downside, obviously with all the other tools telling us that the market was weak. And now we're reaching that 0.5 level also. If we gap down this morning below 6,700, we'll be reaching an extreme also. Again, reaching an extreme is, on the GEX ratio does not absolutely mean that we're going to bounce. It just means that we could be in an area where the fear and greed component would take over on the greed side, and we would see some monetization of those puts and see a short-term bounce. Now, the short-term bounce in the overall market due to put monetization or expiry can only last so long unless we see the out-of-the-money call speculation come in to continue to drive the bus higher. I think that's the key point and key takeaway that I covered previously. We'll get that initial bounce to the upside via the put monetization or expiry. But then if that is not met with out of the money call speculation, that sustained price bounce will not continue in the overall market. All right, moving on to delta balance. Again, we continue to see negativity here on the delta, on our delta balance tool. Quick orientation, the green is the right-hand plane. That's the out of the money call speculation. The red is the left-hand plane. That's your in the money calls and out of the money puts. The green is obviously in the money puts overhead. And then the aggregate is the delta balance. We're well below the zero line. The projected expiries into next week, well below the zero line, delta balance pegged at -1. So all of this continues to be bearish overall structure and sentiment positioning into next week. So again, indicating we could see more weakness. The only positive is the right-hand plane, or sorry, left-hand plane below spot price is slightly above zero. Again, that could have implications of out of the money put speculation being taken away and in the money calls being a little bit supportive. But again, the aggregate is the delta balance is below zero, a slight positive slope, but nothing really to write home about. And then the projected on out in time is bearish structure and sentiment. So we'll see how this continues to play out after Friday's expiry into Monday over the weekend when we get the OI updates. All right. Excuse me. Moving on to our net stack command, which was high sensitivity levels for today. 6750, I talked about that on our X post. Delta balance in the money calls below us. You see that in the money puts above, basically 4-1 or 5, almost 6-7 to 1. Sorry, of overhead headwinds via these in the money puts. So again, it's going to be very difficult to move up in the overall spot price appreciation to the upside. In the money calls here, obviously 6,000 strikes, significantly below us. But that's that first sensitivity level, so really out of reach and not really in the realm of possibilities. So what we'll watch at the open is this will update with the gap down and for spot price. So we'll see if this in the money calls changes below us any. Net charm 6650 out of the money puts here, in the money puts overhead 6750. Again, those will be those key levels to the downside and to the upside. We'll be watching via gamma as well as net Vanna, fairly balanced here. So really no contribution, via Vanna, and then gamma to the downside, 6650, 6700 to the upside. So we'll watch these sensitivity levels. But again, if we do see any bounce, we'll talk about that on the 0DT here as we head into there. So put dominated structure for 0DT, again, negative gamma condition. So again, accentuated price movements. The bottom of DS is roughly around 6720. That would be that key area I'd watch for a bounce to the upside, and then possible failure. The next area would be 6750. That would be the next failure point. To the downside, if we get below 6700, be watching for a move down towards 6680. And then we do see some green net delta start coming in as these are in the money calls below us, out of the money puts. So obviously those are exerting a little bit of more force here. So these could be an area where we see some bounce, 6650. Again, we'll be watching our intraday call put speculation via our vol-m command. We had extensive posts yesterday about that. That's just the mass of market participants and where they're transacting. Are they transacting more to the downside, transacting more to the upside, or fairly balanced? If they're transacting more to the downside, then we could see more weakness via negative call and put centroids. You can check out the X post from yesterday. And then we saw the turn back to the upside kind of the middle of the day and then sell off back down. Not really expecting us to get much higher than the top of transition, 67.65, and then ultimately 67.80 up there would be top of DS and PGEX if we saw some significant bounce or some news event. Obviously, that would be some government, deal back opening, maybe something along those lines. But again, going to be very difficult to move to the upside just via the net stack command, seeing the right-hand plane integral of the in the money puts overhead. And you can clearly see that via our web app here. So again, transition, well below transition, bearish to start the day, below DS, that's also bearish, and put dominated structure. So we would be looking to short any bounces as of now via the market trend model, as well as the sentiment and structure for today. All right, moving on, let's look at the SPX trading view chart. I've overlaid our full expiry as well as our ZRDT and Drunken Sailor for today. You'll notice we're oscillating around 6,700, obviously a key gamma delta level, as well as a psychological level, round number 6,700. You also notice the COTMP level here. Again, that's where out of the money puts go in the money. Again, this is historically where we see some monetization, at least initially, on a move down, and we're just kind of oscillating around there pre-market. So I would anticipate some overnight put holders or weekly put holders are wanting to get paid for their risk. So they're most likely monetizing some pre-market and probably into the open. So we could see a short-term bounce to the upside via that put monetization as well as expiry. And then we'll see what if is met with out of the money call speculation or more out of the money put speculation to the downside. Again, initial bounce up towards 67.20. We'd be watching that for failure. That'd be an opportunity to short. If we do get within the Drunken Sailor range, it could be very choppy, and we'll be watching that via our intraday call versus put speculation on our vol-m command. So hopefully that helps coming into the day. I love any feedback from any people joining us for about the week. If we've been very clear with our message that the market trend model was weak, the structure was weak, we were anticipating more downside. If we weren't clear with that, I would appreciate everybody to give us feedback, how we can clarify that more, how we can use our tools to show how the structure is and kind of what we're looking at for the day. We'll also, I can flip through the SPY here. You'll notice we're below N-Trans and negative GEX, so that starts a weak position. QQQ is actually above N-Trans to start, so still bearish, but if we hold the 600, 604 level, that could be a positive development there. And then IWM is below negative GEX, also at 240, so we need to recover the 240 level fairly quickly to move to the upside. And then we can cover some individual equities via our web app. I'd be happy to pull some up. Obviously, mostly Friday expiries for today on all the Mag 7 stocks. So we'd be looking to next week, most likely, if anybody wants to cover any of those. So again, thanks for joining us, everybody. Like and subscribe on X and YouTube. You'll be notified when we go live with our content. Midday recap as well as post-market recap where we go through our tools. Come join us. Newsletter, punch in your email here. You'll be delivered on the weekend. Basically goes over our thesis, our tools, and how we look at the SPX options structure. So let's look at Hood, and then I'll answer some questions. Good morning, Tom. Thanks for joining us. Hood, let's take this expiry off. So just remove that really quickly from our web app, and then you can look at the rest of the expiries after this Friday expiry. So call dominated on Hood. We are below transition. You'll notice a significant amount of red net delta. So that's put speculation through the whole structure, even though we're still call dominated. So price appreciation is probably going to be difficult unless you get through transition. Let's just look at next week's expiry isolated. Put dominated below transition. PGEX 135 COI, so that would be a cap on price. If you traverse through transition, you can see that's pretty messy within the money puts overhead. So these would have to change pretty significantly. And we do see the structure advance a little bit after the next expiry, but in the money puts overhead and put dominated, so it's going to be difficult to traverse to the upside most likely. Hopefully that helps on that. Price action telling me to stay short below the open with the gap down. Yeah, the only thing I would say is I'd be cautious of some monetization at the open, possible quick bounce to the upside. And then we get reorientated with our levels as well as our volume command, and we'll be indicated where market participants are transacting. Or we could just have a quick move to the downside, either one. But we're oscillating right around that 6,700 and COTMP. So key level there could be very choppy price action at the open. I would assume with the gap down also, it's going to be emotional. People opening brokerage accounts and looking at the market from the whole week. If they try to do a recap of their accounts on Friday, then there could be some emotional selling at the open. So we'll just kind of see. But yes, the overriding factor is market trend model is weak, structure is weak, and we're below prior day low, at least on extended hours, as well as transition area. So a quick bounce back to 6720 would probably be that first area I'd be watching for stalling or failure to the upside to give us some more information for the day. So and trend for the day. So. All right. Anything else? Any other tickers anybody wants to cover? Any other information? I need to clarify anything or do any more in-depth? I'd be happy to go do that. All right. All right, everybody make it a great weekend wherever you're at. Looks like it's going to be a beautiful weekend here where I'm at. So get out and enjoy the weather. Manage risk as always. Tesla, yeah, we'll cover that one. Yeah, no problem. Appreciate everybody for joining us. Tesla, here we go. Awkward yet funny. I like that. I like that screen name. All right, so Tesla 500 still continues to be the upside target. We are below transition on all expiries. Let's remove this expiry here. So 500 still continues to be the upside there on PGEX. We are below transition though, obviously. Call dominated still for the whole structure. Let's isolate the 14th. Call dominated still below transition. Everything looks good though for upside. So if the market decides to turn back up, that would be one of the first stocks I would go to. It still looks good. Structure still looks good. These puts right here, right below spot price, I think these are opportunistic puts, obviously for just a pullback in Tesla. But the upside, the runway still looks great. Now, if this runway starts to erode to the upside for call speculation, then yeah, I would step back a little bit. Obviously, I would not be entering positions now because the market trend model is saying we're not in conducive swing environments. So I would not be entering. I'd wait till our market trend model turns back to the upside. And if Tesla remains call dominated and the out of the money speculation runway to the upside looks good to 500, this would be one of the first stocks I would enter and go to. So yeah, VIX is higher as well. Absolutely. So if we see a drop in VIX though, obviously that drop in volatility, and Vanda today is fairly balanced. So not really seeing a significant Vanda contribution on the 0 DTE. So is there a way to tell where dealers want the price to be pinned at close for a ticker for the end of the week based on gamma profile? I would say no. Is there a way? Absolutely, probably yes. But in simplistic way, the easiest way would be look for your Friday expiry. Yeah, so I would say that would be an SPX. I would assume you're asking individual ticker. That's more of an SPX positioning than individual tickers from my point of view. So I think the SPX would do a much better job of that. And so the gamma profile, yes, that is the transition areas, and what we term as the zeros. So within those transition areas and the zeros, the dealers do not have to hedge, and that would be low exposure areas. Once you start moving out of those zero areas and transition areas, then that can induce some dealer areas where they have to hedge. And that's what I would say about that. So if you're within the transition areas, and then we use our vol-m command intraday, that lets us know trajectory and possible closing price with our linear fit lines, then that gives us the pinning indications of where those may be. But basically would be low exposure profile where it's fairly balanced. That would be the key. And our web app is able to do that. And we're getting ready to produce some other tools that I think are going to be very advantageous for that. So yeah, which strikes keep them gamma neutral. Yeah, gamma and delta. Don't forget delta also. Delta is a key component there because mechanically opening and closing of contracts changes the hedging structure and environment, right? If I open a significant amount of out of the money calls, my book gets longer, positive delta, dealer book gets shorter, negative delta. Also, as we say here, moneyness matters. So if the SPX is just oscillating around a few strikes, then there's really no hedging that has to occur. When we start moving these larger strikes out of the money or in the money, that's when some of the hedging has to occur. So market maker, dealer hedging. So hopefully that makes sense. That's why moneyness matters. That's our key phrase. All right. Thanks everybody for joining us. Make it a great weekend and manage risk as always. We'll see you next week.